Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Nike stock by analyzing their financial statement and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 153 billion market cap. They're trading at 101 a share and they have 1.5 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow went up from 6 billion to 6.3 billion, so fairly steady. It was low in 2022 and 2023, but it rebounded nicely in the past 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's really steady from 5.7 billion down to 5.3 billion. It peaked in 2022 at 6 billion. Revenue is a sales for the company, and that goes up a little bit each year from 44 billion to 51 billion. It had a nice pop in 2023, 10%, but it's only up 1% from 2023 to the trailing 12 months. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 131 billion. We discounted the numbers back to today using the weighted average cost of capital. We get a value of the company of $117 billion. We divide that by 1.5 billion shares. And we get a calculated stock price of $77. They're trading at 101, so they're trading at a 31% premium. It's a sell according to the model. So you can see my future free cash flow growth is much higher than prior years, and it's still overvalued. But the fundamentals are just one part of the market. Market psychology and market sentiment are a large part, and they dictate the market in the short term. There are 14 companies in the same industry as Nike, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the most in CapEx out of all the companies. CapEx is the investments in property, plant, and equipment. Their debt to equity ratio is worse than the median, better than the average. For every dollar of equity, they have 90 cents of debt. They pay a 1.4% dividend. Wolverine pays the highest, 4.7%. They generate more free cash flow than the other 13 companies combined. Their market cap is larger than the other 13 companies combined. All their price multiples are worse than the median, so they do seem overvalued according to the price multiples. They generate a lot of revenue, much more than anybody else. Their 5-year annual revenue growth rate is starting to plateau. It's only 6%. The average is 22%. A lot lower than Deckers, Skechers, and Crocs. Let's take a look at their most recent 10Q. This is as of 11/30/2023. Their revenue in that quarter is 13.4 billion. Last year was 13.3 billion. For the 6 months ending 11/30/2023, revenue of 26 billion, same as last year. So really steady revenue, not much growth. Let's see if they give a breakdown of the revenue. Here's a great breakdown of their revenue, the 13.4 billion. 9 billion is in footwear, 3.8 billion in apparel, things like hats and jackets, $500 million in equipment. This is a breakdown by location. 5.6 billion of their revenue is in North America, 3.6 billion in EMEA, 1.9 billion in China, 1.8 billion in APAC and Latin America. Nike makes up 12.9 billion of their revenue. They also own Converse. That's 519 million. They acquired Converse a long time ago in 2003, so 21 years ago. And they paid 300 million for that acquisition. And just in the most recent quarter, revenue of 519 million. More revenue this quarter than the entire acquisition price. Let's go back to the income statement. Below revenue is a cost of revenue, 7.4 billion. These are all the expenses directly tied to generating the revenue. All the expenses to make their products. That includes the rent for the factories, the insurance, electricity bills, the payroll. Revenue minus cost of revenue gives you your gross profit, 6 billion. That's up from 5.7 billion. This income statement is better. It shows their margins. Gross margin, 44.6%, up from 42.9%. That means they converted 45% of their revenue into gross profit. Gross profit over revenue equals 44.6%. 1.1 billion of demand creation expense. All their marketing is part of this expense, demand creation expense. So television ads, money they give to athletes. Operating overhead expense $3 billion. So their total selling and administrative expense $4.1 billion, which is 31% of their revenue, same as last year. Their net income is $1.6 billion, up from $1.3 billion. EPS of $1.03, up from 85 cents. So their EPS is up 21% from last year. The reason their net income is up less is because they have less shares outstanding than last year. EPS, earnings per share, is net income over shares outstanding. Last year they had 1.55 billion shares outstanding. Now they have 1.52 billion. Let's look at their balance sheet. This is as of 11/30 compared to 5/31. Current assets $24.6 billion. Current liabilities $9 billion. So their current ratio is above a 2. They have nearly $8 billion of cash on their balance sheet, $2 billion of short-term investments. If you were curious what the short-term investments are, they give a breakdown here. U.S. Treasury securities, $1.4 billion, $500 million of commercial paper. So really liquid, safe investments. They have $5 billion of accounts receivables. This is how much money other companies owe them when Nike sells on credit. $8 billion of inventory. Most of that inventory is Nike, $7.7 billion, $300 million of Converse. Here's a different breakdown of their inventory. $3.3 billion in North America, $2 billion in EMEA, $1.2 billion in China, and $1 billion in APAC and Latin America. They also give a nice breakdown of accounts receivables. Of the $4.8 billion, $4.5 billion is Nike, $228 million Converse. Of their accounts receivables, $1.9 billion in North America, $1.4 billion in EMEA, only $200 million in China, and over $900 million in APAC and Latin America. Their PP&E is $5.2 billion. Instead of buying assets, some companies lease them, and the value of those assets they lease is $2.9 billion. That's called a right-of-use asset. They lease it, but carry it on the balance sheet as if they own it. And if you want to know how much money they owe on these assets, it's right here, $2.8 billion. Operating lease liabilities. They don't have much goodwill, only $280 million. And $4 billion of deferred income taxes. These are taxes Nike will eventually pay, but are not due yet. Let's look at their liabilities. $2.7 billion of accounts payable. This is how much money they owe other companies when they buy on credit. $5.5 billion of accrued liabilities. Payroll is a common type of accrued liability. Let's see if they give a breakdown. Here's a breakdown. $1.3 billion in compensation benefits. That's payroll. $1.1 billion in sales-related reserves. So they have to give commissions to their salespeople. Dividends payable, $568 million. Taxes, $500 million. Endorsement compensation, how much they pay athletes, $400 million. And their biggest liability is debt, $8.9 billion. Assets minus liabilities equals equity, $14 billion of equity. They raised $13 billion from selling their business. They profited $1.2 billion from running their business. Retained earnings will be a lot higher if they didn't buy back stock. But when they buy back stock, they decrease retained earnings. Some companies separate it out and list treasury stock, which is a contra equity account. They combine it. Let's look at the statement of cash flows. This is for the trailing 6 months. Operating cash flow, $2.8 billion. Double last year's of $1.4 billion. Operating cash flow is the cash a company generates from running their day-to-day business. The second section on the statement of cash flows is investing. They spend about $500 million in PP&E, property, plant, and equipment. In their financing section, they bought back $2.3 billion of stock. This is for the trailing 6 months. Last year, $2.6 billion. They paid out $1 billion of dividends, a bit more than last year, about 10% more. So in their financing section, they had a cash outflow of $3.2 billion. If you sum up cash flow from operations, cash flow from investing, and cash flow from financing, they had a cash inflow of $478 million in this accounting period. So the beginning cash was $7.44 billion plus $478 million. The ending cash for the period is $7.9 billion. Remember these two numbers, 7.44, 7.91. Let's go back to their balance sheet. And that's their cash. On May 31st, 7.44. That's at the beginning of this accounting period. At the end of the accounting period, $7.91 billion of cash. That's how the statement of cash flows and balance sheet are connected. I'll show you how the statement of cash flows and the income statement are connected. In the first section of the statement of cash flows, cash flow from operations, you start with your net income, and then you adjust for the non-cash items on the income statement. That's how you get your cash flow from operations. Net income of $3.028 billion. Remember this number? Let's go back to the income statement, and you can see their net income is $3.028 billion. That's how the income statement and statement of cash flows are connected. There are other ways these three statements are connected. I'll show you how the income statement and balance sheet are connected. The net income was $3.028 billion. This is on the income statement. At the end of each accounting period, net income is added to retained earnings. This is the balance sheet, the equity section. Their equity is $14.1 billion. The beginning of the 11/30 accounting period, which will be June 1st, 2023, is the end of the May 31st accounting period. So the beginning equity for this 6-month accounting period is $14.0 billion. The end is $14.1 billion. The equity section at the beginning of the 11/30 accounting period is $14.0 billion. The equity balance as of 11/30/2023 is $14.1 billion. To get from $14.0 billion to $14.1 billion, you have to add your net income. You also add and subtract other things. You always add net income and you minus out the dividends you paid. They bought back a lot of stock in this accounting period. But that's how the income statement and balance sheet are connected, or at least one of the ways. Because at the end of each accounting period, you zero out your income statement and you move the entire amount, the net income, to your retained earnings on your balance sheet. And then at the beginning of the next accounting period, in this case, their next accounting period would start December 1st, 2023. The income statement will be totally zeroed out, and they would have to add revenue and expenses. But their balance sheet is ongoing. So you see this $14.1 billion, that's your equity on your balance sheet. And you see this $1.15 billion, that's your retained earnings. At the beginning of the accounting period, it's $1.358 billion. At the end of the accounting period, it's $1.15 billion. I'll show you on the balance sheet. You see $1.15 billion on the balance sheet. Last accounting period, $1.358 billion. Everything in the equity section, the Class A convertible, Class B, capital and excess, accumulated other comprehensive income, it's all broken down for you in the statement called Consolidated Statements of Shareholders' Equity. The way your retained earnings are calculated, you start with your beginning period balance, you minus out any buybacks, you minus out the dividends, and you add the net income. The number I showed you earlier was total equity. Total equity is a sum of retained earnings, accumulated other comprehensive income, capital and excess, Class A shares and Class B shares. Interesting stuff, I know. Let's look at the stock on Simply Wall Street. Its last price 101, a 153 billion market cap, down 2% in the past week, down 21% in the past year. Let's see what they say about Nike. They design, develop, market, and sell athletic footwear, apparel, equipment, accessories, and services worldwide. The company provides athletic and casual footwear, apparel, and accessories under the Jumpman trademark, casual sneakers, apparel, accessories under the Converse, Chuck Taylor, All-Star, One Star, Star Chevron, and Jack Purcell trademarks. They also sell a line of performance equipment and accessories comprising bags, basketballs, baseballs, socks, eyewear, timepieces, digital devices, bats, gloves, protective equipment, and other equipment for sports activities under the Nike brand. The company markets apparel with licensed college and professional teams and league logos, also sports apparel, and licenses unaffiliated parties to manufacture and sell apparel, digital devices and applications, and other equipment for sports activities under Nike-owned trademarks. It sells its products to footwear stores, sporting goods stores, athletic specialty stores, department stores, skate, tennis, and golf shops, and other retail accounts through Nike-owned retail stores, digital platforms, independent distributors, licensees, and sales reps. They were founded in 1964, 60 years ago, in Beaverton, Oregon. If you live in Beaverton, let me know, and I'll pin your comment. Here's their stock price since 1990. It did really well up until 2020, breaking through $100. Then the COVID crash, it fell below 70. Then it peaked at 174 at the end of 2021. but it's down about 40% since that peak. Simply Wall Street's valuation is 71. They say the stock is 42% overvalued. 37 analysts priced this stock at 123. Their revenue forecast for 2024 is $52 billion. 2025, $55 billion, 2026, almost $60 billion. Here's their debt since 2013. It was really low back then. It peaked at $10 billion in 2020, and it's pretty much at that point currently, a little lower. But their equity is higher than their debt. Their debt to equity ratio is 63%. And this green line is their cash. They usually have more cash than debt, so they're in really good shape. Their dividend back in 2014 was 1.3%. It fell to 0.7% in 2021. But look at the forecast, 1.7% by 2026. The CEO's salary is $1.5 million, total compensation $33 million. His tenure as CEO is 4.1 years. 68% of the company is held by institutions, 21% by insiders, and 11% by the general public. The founder of the company, Philip Knight, is the biggest shareholder, 17.4%. His shares are worth $26.5 billion. His son, Travis Knight, owns 3.1% of the company, Pi 3.14%. There's other big shareholders, Fidelity, Northern Trust, UBS, Goldman Sachs on the bottom at 0.5%. And they have lots of employees. It was 48,000 in 2013. It's at 84,000. The ticker trades in lots of places. The New York Stock Exchange, Deutsche Börse, Xetra, Santiago, Swiss, Mexican Bolsa, London Stock Exchange, Lima Bolsa, Wiener Börse, EuroTLX, Kazakhstan, Santiago, Bulgaria, BATS Europe, Buenos Aires, Sao Paulo Bolsa, and the NEO. So let me know what you think. Give the video a like, subscribe, or comment below if you'd like to get a custom valuation or just support the channel. You can become a member by clicking on the link in the description below. Thanks for watching.